Good morning, traders. It's Monday, June 13th, and we've got a bloodbath happening in the markets today. Obviously, people concerned about stagflation, inflation continuing. It's not a pretty picture out there. We got the NASDAQ down 3% this morning, SP 500 down 2.3. The Dow's holding up the best, down 1.8, and the Russell is down 2%. So pretty big down day. When you take a look at the daily chart here on the right-hand side, you can see the big last Thursday, Friday, huge waterfall sell-offs. Today is a gap. So it gave the weekend for people to start overthinking, get really nervous, and just convince themselves just to get the heck out. And they're all placing orders, getting out today, and it's creating a gap and a big sell-off. So we'll have to see what kind of move this is, if this ends up being some huge washout spike low and reverses, or if it's a big strong breakdown and it picks up speed and keeps going lower. But we can see here for really since last November, kind of the market more or less topped out, started to get really choppy, and it has been trending sideways and lower. And this is the nice thing about following technical analysis. Sometimes we don't get a lot of trades, but we can avoid massive crashes, and this market is down huge, and that is the key, is protecting long-term investments, protecting our short-term trading accounts. And it is tough to get short trades in a market that's mixed like this, when we're not in a full-on bear market from a technical standpoint on the weekly charts yet. We don't want to be betting short just yet. So we're kind of in this limbo, waiting to figure out if we're going to get a new rally, a big rally, and play the upside, or if we're going to get a breakdown in a big way and start a much bigger bear market. And there's a lot of people saying, bear market, there's only about 30, average is about 38% correction in a bear market, depending how far you look back. But I do think there's a potential here for a much bigger correction than what people are thinking. I mean, the NASDAQ is down already. Let's just take a look at the NASDAQ here from the highs, which is right up here, to where they are this morning, which are new multi-month lows, down 31%. To me, this is just kind of the start of the bear market, and I think it could still go down another 30%. To be honest, I think things could get pretty ugly, and that is why we've got to protect our capital. And avoiding all this is a pretty exciting, pretty good feeling, knowing we're not riding this down. And that's really important, because so many people keep wanting to try to make money from the collapse, and it's not as easy as you think. And we're in this mixed market, and anyone betting to the downside, definitely the bias is there. Looks like the odds are with you, but just keep in mind the markets in general, when we're focusing on the SP 500 and the Dow, they are just still kind of in this major topping phase. It feels like the momentum and everything has shifted, but we're not in the by the short ETFs yet, the inverse ETFs just yet. Let's take a look at what is moving today. So stocks are down, bonds are down. Bonds are starting to break down in a big way. Broke the low from about a month and a half ago, 2 months ago, and they're in free fall mode, which is not good. And if we take a look at the VIX, it's up 17%. It is back up near these highs. Definitely been seeing some pretty high VIX. There will be a point here where I think we get some massive spike and blow off. If we were to go back far enough, we can see the 2008 kind of bear market spike, where it's complete panic. And when you get those huge panic waves, the market can recover usually. But overall, fear is back up to these levels that we've seen many times over the past almost year already. If we take a look, obviously there is a flight to safety. People are literally just cashing out of everything. Almost everything is red today other than the dollar. People are selling and cashing out. And we are seeing the dollar. It's had 3 massive days back to back in rally mode. It's held that 50-day we were talking about is a pretty critical, significant level. And if we were going to get more selling in the stock market, the dollar was most likely going to rally. We're going to see massive fear, and that means metals will be going down, because it's got 2 things going against the precious metals, which is the rising dollar and panic selling. And that's what we're seeing today. Gold down 0.8%. It had a beautiful day on Friday. Nice big strong pop, got above the 50-day. Today it's moving back down. Now gold in general is holding up fairly well compared to obviously the stock market. If we take a look at gold for this year, where is it right here to where it is right now, Gold is positive by 1.6%. So it is definitely outperforming the stock market. It was up dramatically. It's pulled back since then with some fear. We'll have to see if this ends up being a bear flag and moving lower. But if we continue to have some fear, I think we could see gold pull back and chop around a bit more. Again, the big picture, we talked about this Friday in the live mentoring session, the big picture for gold, I'm still very bullish on gold. We are coming into that, I think, prime time where a super cycle for commodities is just starting. We got years to go, I think. And we've got inflation, stagflation. I think people are going to start to really worry. And I think gold and silver and miners will do fairly well in the long run. We just need to see how the panic is going to affect these commodities. If we go take a look at silver, down 2% this morning. Silver not grabbing quite as much of a bid last week on Friday. It had a little recovery, sold off and then rallied back, but it's more of a speculative play. So there's still some fear in the market, and it just hasn't really popped and started to take off just yet. And of course, if we take a look at the gold miners, let's take a look at GDX. Had a big gap down. We talked about it early in pre-market that day, that it looked like they might come back to life and actually start to become a defensive play. They had a huge engulfing candle, meaning it gaps lower below the previous bar, fully engulfs it, goes above it and closes above. That is a very strong candle pattern, and we're going to see it pull back a bit today because the stock market is selling off hard. Fear is going to pull. There's naturally going to be sell orders, but overall, I think we are seeing the precious metals coming into a sweet spot here. Very slowly, quarter by quarter, we're getting closer to the metals market, I think, finding their stride. And it's going to go from everyone being in crypto, digital, nothing backing it, to everyone going back to the basics, buy physical blocks of metal. And it's how the world goes, back and forth. It goes in cycles, one extreme to the other. And we're in that scenario right now, very similar to 2000 tech bubble, where commodities were extremely overvalued back down at the levels we're at right now. And that's when gold had started a massive multi-year rally that went on for 12 years, 11 years. Let's take a look over at, there is a bloodbath in the crypto space this morning. It is not a defensive play. You can see it's down 18.5% this morning, just in free fall mode. We've been talking about this. We got about a $21,000, $22,000 downside target based on this bear flag, and we are pretty much, where did it get down to this morning? Let's just take a look. 23,500 continues to sell off. And let's just zoom out on the daily chart so you can see where we're going. And we'll throw a line across here. It's a pretty significant level where it's trying to hold these levels, and it's breaking down as we speak. So definitely some big volume, and this could continue to unwind. I think Kathy Wood was saying just last week, I think, that she says Bitcoin's going to $1 million. Pretty extreme. Anyways, we're going in that opposite direction for now. This could completely unwind. We've talked about it. I've got the next target. There's a target around 16,000. I have a target around 11,000. So there's a lot of downside for this to completely unwind. This is like a pretty big phase where there's a lot of people piling in. A lot of businesses started in here, and typically once it becomes a crowded space, it becomes volatile, puts in a top, and then completely gives back all those gains. And that's pretty much what's happening. Another thing that is interesting, I was reading an article last night that the 2008 bear market, they said they thought killed, it was just over 5,600 people from financial stress, suicide, all kinds of different reasons, because, and they linked it to the stock market declines. They couldn't handle the equity value drop, and it's something I'm working on in a white paper to explain this how serious bear markets are, how serious position management, getting out of trades really is. And we had just a couple of years ago the 20-year-old Robinhood trader who ended up just playing options, not realizing the values when you sell options or buy options. It shows huge value swings in your account, which don't actually mean that's what you're down or anything. He was down 700 and change, and he ended up taking his life. And we're getting into scenarios here where people don't have the education, they don't know what they're seeing in their brokerage accounts, they're taking huge losses. Margin calls are going to be crazy today, and it's a really serious time. And it's not about trying to trade and get super aggressive and try and make money. It's about understanding the risks, protecting our capital. I would love to play this downside move. We haven't had a trigger yet. And the key here is, in the end, we want to be one of those people who have got lots of cash raised. We're ready to put money to work at the end of a bear market where we can make ridiculous, huge returns, getting in on great companies at low prices and moving forward from there. We don't want to do what everyone else does, which is hodling, which is holding on for dear life. It's just the old way of doing things. You don't just buy and hold because things can get pretty ugly. We've seen the SP 500 sell off, took 12 years to come back. The NASDAQ took like 16 years to come back. And something like that could happen again. It's always when you least expect something is when it's going to happen. And that's kind of the vibe that's going on. Everybody thinks real estate and stocks are the play, and they could be out of favor and underwater for, who knows, 5, 10, 20 years. You never know. And real estate is going to be under huge pressure going forward. The mortgage rates in the States, I think, went from like 3 to 5.5% in only a few months. Is a huge jump. And we're already seeing real estate correct 15 to 20% in a bunch of different towns and cities. And it's pretty big. So this is all really serious stuff that's going on here. And it's about protecting capital in a bear market and a topping phase like we have in the stock market. And we're about to click, I think, into a full-on bear market. And it could last a long time. I remember if we just go back. We go back over here. I remember this bear market here, the 2000, and that one lasted, we're looking at three years. It was a very long bear market and painful, and a lot of damage is done. The 2008 was a lot more swift. The one that we saw with COVID was a pandemic crash. It was so quick and recovered so quickly that a lot of people didn't have time to settle in and cause a lot of damage. People would get their statement and it had already recovered most of the loss, so it ended up just being a normal correction. The average correction per year in the stock market is around 18-20%. So most people, the way this collapsed and recovered, people never felt the full wrath of a 34% crash in the SP 500. Dividend stocks, if you're a big blue chip holder, they felt almost 50%. But most people didn't realize it because it was V-shaped recovery. It happened before they recovered before they felt and saw the pain in their retirement accounts. So anyways, let's keep on moving because this is all pretty important, big moves today. Natural gas starting to get back down to this short-term 20-day moving average. Obviously, if it breaches it, the 50-day, and then it could eventually break over. It has had one of these huge parabolic runs where we get these big volatile spikes. It's got 4 surges to a high, which is pretty extreme. Usually we see 3 surges and then a crash. This could be explosive to the upside. It could be explosive to the downside. This is a very dangerous pattern, and we'll just have to see how it goes. I do feel like I feel a little bit more just because I can feel the fear in the markets today. I think we might see energies, which they are moving down today, they might underperform a little bit. People might not be quite as bullish. If the economy is in stagflation, we're going into recession, things are going to slow down. Demand will slow down, but there is the huge issue overseas with the energy crisis, and I think that is more so natural gas. So natural gas is going to continue to be very volatile, and it could still have an explosive move up into the teens with what's going on, but yeah, just volatile, very volatile time right now. Looking over at crude, let's zoom in a little bit here. Crude pulling back today. Still in a very controlled uptrend. You look at the 30-minute chart, rally, pullback, consolidation, rally, pullback, rally, consolidation, rally. Still kind of plugging its way higher. We just got massive panic today and everything is moving down. Just be pure fear. If we go look at the hot list, nothing has really changed. The market is not favorable for stocks. Here's the ARK ETF. It is down at 37 this morning. It is going to be another bloodbath for the ARK ETFs. Anything that's very leveraged in the small growth stocks, the energy stocks. If we take a look at them in pre-market, they're down sharply as well. Everything I think is pretty much going to get hit this morning going forward. taking a look at the other markets, we don't have any new triggers. Nothing's going on. We're just waiting for this market to give us a new trigger, whether it's a long or a short. We just have to wait for that trigger in the markets and just be happy that we are avoiding major market crashes, because this could just be the start. And I know a lot of people are thinking we're close to a bottom. We could be close to a bottom, but trying to catch a falling knife is one of the most dangerous things. If this is a bear market, there's a long ways that it could still go, and you could cut your count in half still and do a lot of damage long term. So it's all about preserving capital. We will stick our neck out. We will get into some trades eventually when they happen, but right now it's about, just outperforming by literally not doing anything. Cash is a good position at this moment, and the markets are going to shake things up, and hopefully we get a new trade set up. Who knows? Maybe next week, maybe this week. We just have to see how things are going to move and flip around. This market is moving fast, so it can turn on a dime and generate a new signal within 4 or 5 days, depending on how things move. Anyways, a little dragged out this morning, but actually let me cover a couple more quick things here. This was an interesting post I saw this morning. Real average weekly earnings sinking at an annual rate. You can see COVID hit. This was the zero rate. Obviously, salaries jumped up big as everyone was getting paid a premium to work during a dangerous time, and people didn't want to work, and those who did work got paid more. But we've been seeing weekly earnings drop dramatically. We're way below 2008. Not in terms of value, but we're seeing continued decline in weekly income. So that's not a good sign. The other thing is we've been working on a infographic here. You take a look here. This is a new chart we've added to our long cycle chart, and more or less wanted to kind of do another chart showing our the stages that the market's in. So stage one is a basing. You can see stage one at bases. It's out of favor. Red means it's not a good time in terms of active trading. It's usually a very choppy market condition. Stage two is where things start to trend and move up. Green, this is when there is a trend and when it's a profitable trading time. There's stage three, which is where what we're in right now with the stock market. And then we get to stage four, which is the bear market, the decline. Again, this is a trend to the downside. This is when we take action on generating trades going against the market, so betting that it's going to fall. And then eventually we go back into a stage one, and then it's rinse and repeat. So this is kind of where we are, the stage three topping phase, potentially on the verge here of starting this major decline. And if we go back over here, I think we're starting to get into this phase right here, this anxiety phase, where people, I think today, this week, are going to start to really panic. Last week, we were in this complacency stage. The last two sell-offs, selling days that we saw, I think started to get us close to anxiety, people starting to freak out. A lot of people, including myself, I thought we were going to get a rally, and I thought we were going to get a new trigger last week to the upside, which would be this complacency rally. And after that is usually when we go into this bear market, but we are slipping a little bit more into, who knows, maybe we're over here with some anxiety, maybe we're already back down over here. We just have to let this market work itself out, but definitely in terms of investor major trends, we are heading into a dangerous zone here in terms of prices will collapse. And if you buy and hold, this is what this is kind of based on. Buying down at these levels and holding long term are good investments. As you get up into these areas, the buy and hold becomes very dangerous. This is where the damage is done, holding and riding these out. Anyways, that's it for this morning. A little longer video than normal, but hopefully you got some good tidbits out of there, and we'll talk to you soon. Bye-bye.